Welcome to SmithWeekly Discussions, an occasional program for our readers and listeners of SmithWeekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine the show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion, we want to say thanks for questions coming from our audience at SmithWeekly, including Cyril O., Paul M., and Nick W. Alex Molyneux is our guest today. Alex is strategic advisor to Eightstone Oclaner's Uranium Fund. The Singapore-based wealth management group utilizes a number of investment strategies. You can learn more about the company via their website, eightstone-oclaner.com. Alex is also involved with a number of listed natural resource companies. Alex, welcome back, and how are things in Taipei?
Thanks, Andrew. Oh well, they're good, and coronavirus free, and a sort of a charging economy here.
Tell us about that for just a moment. We were just talking offline here, Alex, but talk about the COVID in Taiwan, because it seems to be that they did an exceptional job and unique job of handling things.
Well, Taiwan's a very unique place. It's not a member of the United Nations. It's the place known as the Republic of China, and it's the losing side of the Chinese Civil War in 1949. So it's as you know, countries like America recognize mainland China now as the government of China, but Taiwan has retained its independence the whole time, and it's a place that has, as a liberal Western democracy, it has some tensions with mainland China, particularly in the last few years. Those tensions are building up, and they watch China very closely. And back in December, they were already talking here in Taiwan about unusually high instance of pneumonia in Wuhan, and they started, for example, to take the temperature of people arriving on flights from Wuhan, and it was one of the first countries in the world to restrict entry of people from China initially, and then they ended up with quite a broad set of restrictions on entry into the country. And as a result of basically those restrictions, and also a heavy testing regime on any arrivals to Taiwan, they've effectively been able to remain free of any community outbreaks. So there's been roughly 500 cases of coronavirus. The vast majority of those are people arriving in Taiwan, and it's a place where the population is 25 million. So they're doing very well, and they're reaping the benefits of it. The economy is predicted to grow 1.8% this year. The currency is at a 10-year high. They have been affected in a trade sense, but it's a very bizarre place to be right now, because everyone I talk to or globally has got restrictions going on, and we really don't have any restrictions domestically here other than those travel restrictions. Interesting little place.
Yeah, absolutely. No, very unique. Good on you for hanging out there and being able to continue to conduct business with very little interruption.
Yeah.
Well, talk broad markets, Alex. What do you see? I know you follow the markets pretty heavily. And what are your thoughts on the dollar here? Stimulus? What's your thoughts on commodities?
Well, I'm very, very much a dollar bear. I look very closely at the stimulus actions, the debt being taken on by governments, money supply. If you look at the growth in money supply over the last 12 months or so, say in the United States, then in my view, the dollar can drop another 30% or so just to make up for that. I think there's some issues which are actually slowing the dollar's drop. I think a general lack of investment opportunities globally because of the pandemic, some extreme weakness in Europe is actually slowing the drop in the dollar, but it is moving in a negative trajectory, and it'll get there in the end. The other thing that might be slowing it down a little bit is when you look at money supply, you have to look at, money supply in the long term is actually a very good guide to the weakness in fiat currency. But the one thing that you have to look at it together with in the case when you're looking at short-term periods is also the velocity of money, i.e., the speed at which money turns over, because that has if the velocity of money slows down, then it can slow the impact of a growing money supply. And I think that's a little bit what's happening here as well, in that the money supply has been growing at a rate that we've not seen before in our lifetimes. But at the same time, the velocity has reduced somewhat because of restrictions of people's movements, and there's certain activities that people aren't doing and spending money on, and people are hoarding cash because they're worried about job security and things like that. So I think what's happening is the money's being printed now, and the dollar's already responded somewhat, but what's going to happen is eventually we're going to get to the other end of this crisis. And we all know that in the current environment, it's going to be very difficult to pull that money supply back. And then as the velocity of money starts to normalize, I think it'll show up in inflation at that time. So very much a dollar bear.
Speak to that just a little bit more, Alex. What do you think needs to happen actually to see it start that trend lower? It already has to some degree. We've seen a pop, but what do you see as really that final catalyst? Is it getting beyond the current economic conditions where things start to normalize again? And with that, we've seen that commodities at times can be inverse dollar vehicles. What do you see really as a breaking point? Do you see further stimulus and normalization of economic activity, start seeing that decline in the dollar? What do you think needs to happen to see it go lower? And do you see it happening over the next couple of years?
Yeah, look, I think it just continues to go lower as it has for most of this year. My target for the dollar in gold terms is about 2,400, 2,500. That is if nothing else happens in terms of extra stimulus. But I do think there's going to be another round of stimulus coming. I'm not a V-shaped recovery person. Never have been. When you think about the cycle of retrenchment that's been kicked off here, and even if that cycle is really dominant in certain industries to start with, like airlines, cruise, other kinds of tourism industries and whatnot, energy, for example, the oil and gas industry, this cycle has got a lot further to play out. And these government stimuluses, particularly when there's a pandemic going on and when there's effectively a withdrawal of the benefits of global trade, these stimuluses extremely unproductive, if you like. I guess what I'm saying is, in an economic sense, every dollar you put into the economy it creates less productivity, and so we're at the point now where there's so much debt in the system. There's been so much stimulus for various things because this crisis only just coming off in a relatively short time off the back of the global financial crisis, and the government was never able, in the US, for example, only 10% of the increase in the Fed Reserve's balance sheet was pulled back from only 10% of the increase after the global financial crisis was pulled back, right? So we never got that back, and suddenly there's another crisis. And so the stimulus on top of stimulus becomes less and less effective. It's harder to make it go to the place where there's going to be a productive use of that money in an investment sense in the economy, or in a consumer making a rational decision sense. And so we're definitely going to see, in my view, an economy really struggling to come out of the pandemic. And I think we can already see that, where we see some good statistics in certain months. But for example, the bounce back in consumer activities. Okay, well, August consumer activity very good, but when you think about one good month does not make a trend, particularly when that month includes a lot of pent up demand from the decline, from 4 months of continuous decline. So I think that as we get to the later part of the year here, we're going to see these statistics plateau. And a great, one of these statistics plateauing is the employment numbers, the new claim, the weekly new claim filings in the US. That's come off its peak, and it's around 850,000 a week. But this is a number that, if it's to show economic health, needs to be down in the 200,000 type range at a maximum, and it's just sort of running out of puff around the mid 800,000s, and that is an economy that's going to be very difficult to grow, and it's probably going to stay in recession or return into recession. And so there's definitely more stimulus coming, and then when we see more money being printed, we then update obviously how we feel about gold. But for now, I think it's at least going to 2,400, 2,500. We'll see what the size of the next stimulus is. I'd be shocked if we get away with another 2 trillion, because of everybody arguing over the stimulus now. It's already too late to be as productive as 2 trillion would have been if it arrived 6 weeks ago. So, are we going to get 4 trillion, 5 trillion? These numbers are astounding, and once you get a normalized velocity of money, the gold price, write your own ticket. It really depends on the final outcome. Now, for sort of the stimulus programs, until we get to the point where the economy stops going down. By the way, I think it probably goes sideways for a long time after it stops going down, because of that lack of productivity that I was talking about. But I do believe that the whole commodity complex should correlate or should be a positive place to be if you believe fiat currencies are going to be declining. The outcome of all the stimulus will eventually be inflation. Much of the stimulus, if it's actually to really create jobs, will have to be invested in infrastructure, and those dynamics are very good, not for base metals. There's some other secular trends going on, like the electrification of the world and automotive, that is very, very healthy for base metals, copper, nickel, these sort of things. So I think the commodity complex is definitely the place to be. There's a couple of commodities I probably wouldn't want to be in right now. Even though I think there's more stimulus coming in and more infrastructure spending coming up, I think that iron ore has had some supply constraints that are being released at the moment, so I probably wouldn't be in iron ore. But in general, the commodity complex is a great place to be, precious metals and base metals for the next few years.
Yeah, I agree. And, it's tough when you're throwing free money out. It's hard to get productivity coming back from that. So the utility is not there so much, especially when it's mostly consumer based stuff. And as you know, we can't sit here and consume all day and never produce anything. I think that's pretty basic. And it seems like some folks have forgotten about that. One of the things with gold, with your price on gold, Alex, and I see that as very conservative, by the way.
Yeah.
I don't think we've seen any time in the past in history where gold has not at least doubled from its high. So if we go back to 2011 and we see gold at, call it $1,900 an ounce back then, I think we're in for a nice move over in the next few years. And I fully expect that doubling from the high will occur again. So that puts, gold just under 4,000. That's certainly a possible outcome here. But talk about for just a moment, the US dollar is still the prettiest girl in the room.
Yeah.
What's your thoughts on that as people continue to still look to the dollar as the best currency, even though it's got a lot of egg on its face? How do you look at that, and how do you compare that to, the commodity complex moving higher and things like the Canadian dollar and the Australian dollar? What's your thoughts on the outcome there?
I do think that, because just the other day someone was asking me, what currency do I recommend they invest in? Should they buy yen or euro or Swiss franc? And my view with the fiat currencies right now is it's a little bit of a race to the bottom. You've got this sort of coincident global sort of lack, reduction in economic activity going on. So no one can afford their currency, if you like, to be the reason why they slow down even faster. So can the Eurozone afford a very high euro versus the US dollar? It can't really. So I think with fiat currencies, everybody's it's like a competition to lower interest rates and print more, and it's almost impossible to know, the frequency within which governments will take these actions, and to what extent, how far they'll be willing to sort of pull levers for their short-term benefit. And governments do this because it gets them through the next election. The commodity currencies, because they are currencies that get exchanged, that there's a high, because commodity production is a higher proportion of those countries' output. Those currencies will probably do okay in a relative sense. So, the Australian dollar, the Canadian dollar will probably do better than, will probably appreciate in US dollar terms if copper and gold appreciate. But I still believe that that in general commodities will appreciate faster than most fiat currencies will. And the other thing that will happen is your Canadian dollar or your Australian dollar, if it starts to appreciate too much, as I said, these governments will take actions to to try to reverse that trend, because whilst in countries like Australia and Canada, their income from commodities will probably be increasing in this environment. The rest of their economy is still going to be, in pretty difficult shape. And so, and the commodity sector, particularly when you look at minerals, isn't a large employer, for example. And even in countries where it's a relatively large contributor, it's still not a large segment. So, in countries like South Africa and Canada and Australia, the mining oil and gas industry is 10 to 15% of GDP. So it's not, so that these countries can't afford to let their currencies loose, if you like. They need to try to cap appreciation versus other currencies.
Yeah, it'll be interesting to see what happens. I think if folks have exposure to the commodities complex, most of that being sold in US dollars. I think that's really the best place to be. And really the currency differences with those particular ones we mentioned are probably just a rounding error, and that people should really pay attention to having exposure to the commodities themselves. Alex, how about let's move on here. Let's get into, I want to talk about uranium here in a moment, but
Yeah.
can you just overview briefly each company that you're involved with, and then let's get on to uranium.
Yeah, so I'm involved in a couple of companies, and I have a couple of roles in the industry, mainly because I've been in the industry for more than 20 years, and the first half of my career in the industry was as a specialist metals and mining investment banker. So, in that early part of my career, I had a lot of experience with different commodity exposures and businesses in different stages of development within the industry. And my experience was obviously as a banker was very focused on financing and helping companies grow and develop. So I find that I tend to get involved in companies in different segments that are in the growth and development phase. I don't do things that conflict, right? So you won't see me on the board of two royalty companies or uh, things like that. So, but you know, yeah, commodities in general is somewhere where it's an industry where portfolio exposure makes more sense than a lot of other industries, because industries within them, or commodities can be exposed to external shocks and things like that. So you don't necessarily want to focus your whole life on commodity A and find that you make a lot of progress, but something comes out of left field to hurt that commodity market. Fukushima, by the way, and uranium is such an example, right? Um, so so a bit of portfolio theory is useful. I'm on the board of Metalla Royalty and Streaming, which is one of my all-time favorite companies. It's a gold and silver royalty company. It's listed on the Toronto Venture Exchange and also on the New York Stock Exchange under the ticker MTA. Metalla has basically it's been around a 10 bagger in the last 2.5 years, and there's a great guy running the company, a guy called Brett Heath, who invited me to join the board just after the company was first listed, and Brett knows every gold property and prospective gold property out there. And it's really through the knowledge in his mind that he's been able to identify individual royalties and portfolios of royalties that Metalla can buy relatively cheaply. And in the last 12 months, for example, Metalla has done 19 royalty acquisitions, which is, most royalty companies might do one, two, three, or four in a year. And these acquisitions have generally been, very well regarded by the market and analysts, and have really been additive to the company. And Brett continues to go, and this company has got to a 400 million Canadian market cap, and is really now getting to that point where the next scale of growth is economy of scale. It can take on a little bit of debt leverage. It's a very, very attractive vehicle for larger counterparties to sell packages of royalties to. So I think that's a great exposure for precious metals, people that want to get their gold and silver exposure, because this company, it's got more than 50 royalties now. So it's got within it, it has it's like you can own one share and you've already got the risk mitigation of portfolios, but it also has the same benefits as a mining company when the commodity price is going up, in that in that its production grows, if you like, because people start to develop some of the undeveloped properties we have royalties over, or some of the production royalties we have, people start to expand those mines and whatnot. So that's a great company. There's a company listed on the ASX where I'm currently managing director. It's called Galena Mines. Galena, listed on the ASX, has its ticker is G1A. It's a company that's done. It's been very fortuitous as well. It listed in September of 2017, and in that 3 year period since listing, it's gone from around a 10 million market cap Australian dollars to about 115 million Australian dollars. And it's gone all the way from declaring a maiden resource based on initial drilling results, to doing its feasibility study, to having Japan's #1 lead and zinc smelter come and take a minority joint venture stake in the project. It's sold its offtake to tier one counterparties. It's fully permitted, and just at the very end of August, at Galena, we announced a US $110 million project financing debt facility, which is the debt, the debt required to build Galena's flagship asset, which is the Abra mine. The Abra mine is a polymetallic deposit, but at the top of the ore body, you have lead and silver, and at the bottom of the ore body, you have copper and gold. So the feasibility study is based on the lead and silver production, and it's lead at the moment is in short supply. It's a base metal, and it's the concentrate that Abra produces will be the highest grade concentrate available globally, and the lead industry, like any other industry in terms of processing, is becoming very focused on environmental issues and the cost of processing. So clean concentrates get a premium in the market. It's another great project to be involved in. So I highlight those two. There's other boards I'm involved in, but I know we don't have all day here, so I'll just highlight those two. And then, of course, as you said at the start, the Eightstone Oclaner advisory role, which I think you'll ask me about, uranium.
Good performance coming out of Metalla. A lot of competition in that space now. Of course, we monitor and watch. We have a few positions. Metalla is not one of those that we didn't get on board with back in the day. However, we should continue to watch it. With Sandstorm out there and Mavericks, Metalla, Nomad, you've got Vox. Yeah. Got Triple Flag potentially coming in at an IPO at some point. You've got obviously your majors, which I don't need to mention. So quite a highly competitive space, but good setup there and good things going. And certainly it's royalty companies that certainly has a space in our portfolio. How'd you do for cost of capital, Alex? How did that go? Because you and I haven't spoken about progress at Galena since, I want to say it was, when did we talk? 2019 sometime. How would you guys do on cost of capital on the finance package?
It's all relative. This is the year of Corona. So we were very, very close to closing a bank financing on that project in March, when sort of the VIX index went through the roof. The banks basically froze up at that point. So we really had a choice then to kind of ice the project until we felt like the banks are coming back. By the way, the banks in a place like Australia too are not like that. They are slowly coming back, but they're still extremely nervous, and they're benchmark interest rates have come down, but the banks have increased their margins on lending as well. By the way, this goes exactly to that point that we said about the productivity of stimulus money, because you put this money in the economy and the banks just sit there and and you lower interest rates, and the banks sit there and increase the margins, so they don't make debt more available. So what we did is we quickly pivoted to a non-bank process, and the winner of the non-bank process was Taurus Funds Management. It's a Australian-based group who runs debt funds. Incidentally, most of the money comes from US endowment funds, US pension funds as well. It's obviously an investment strategy for them to get a bit more yield. So Taurus manages the fund and identifies the investment opportunities, the structures and whatnot. Now, the cost of capital for us, the coupon on the Taurus debt is 8%. The whole package that we're getting from Taurus is around 3% more than the all-in cost of funding from banks. But let me also say, the structure of the Taurus facility is a bit more flexible than a typical bank facility. So you pay a little bit more, but that extra flexibility actually provides us with a more conservative situation in that the scenarios under which you might breach covenants and things like that, there's a little more flexibility around that. So you pay a little bit more, but you get a better facility. So we're very happy with it. We as I said, we announced at the end of August that we're just going through the sort of final documentation on that, and we're hoping to sign that facility agreement in the near future.
Yeah, that's not so bad in the current conditions. That's not bad at all. I mean, quite honestly, that's maybe only a point and a half off of what it should be in normal conditions. So I think that's pretty good. Let's move on. And good job with the progress. That company's performed really well, and glad you guys are keeping on track and things are moving along in a good, suitable fashion. So as the audience probably knows, you're an advisor to the Eightstone Oclaner Uranium Fund. Maybe just overview that fund, how the performance has been, and what the strategy is at that fund, Alex.
So that fund started in at the very we launched that fund towards the end of 2018. Oclaner I knew when I was in my previous job as CEO of Paladin Energy, which at the time I was running it was one of the largest independent uranium producers in the world. And as you know, it's still a significant one of my jobs was to put those mines on care and maintenance because of the low uranium price environment. So it's not a major producer today, but it's got one of the highest quality asset suites globally. And so Oclaner approached me at the end of that and said, that what they do is Oclaner has family office clients and ultra high net worth clients and whatnot, and so what they try to do is come up with innovative investment strategies that those clients should be looking at, and when the strategies are hard to execute publicly, they create their own vehicles. So they sort of came to me and said, listen, we think that uranium could be an interesting trade in the next few years, and we don't like the uranium at the time. The URA ETF had a lot of non-uranium exposure in it. There weren't other significant investment funds that were structured in a way that appealed to their clients. So we set up a fund that it has one mandate only, to buy uranium exposure. Its investment structure is through equities. It doesn't have any leverage in it. So we can either be in cash or uranium equities, basically. And So there's nowhere to hide for us in a way, and we just try to manage the fund to ultimately capture the incredible beta that will come in the uranium equities to the uranium price when that market moves over the next few years. Now, the fund performance, it's in the mid 90s in terms of, let's say, if you said percentage of its inception value. So we started investing at the end of October 2018, and we were doing very well for a while, and then if you remember, the sort of the market fell in a bit of a heap in around about July of last year, I think, when Section 232 disappointed, and we had a bit of negative performance then. But we've almost made all of that back. We're outperforming the uranium peers that publicly state their performance as well, and we're outperforming the ETF. So we think we're going very, very well. We're very well set up here for what's coming next.
Just talk briefly about just what your guys' kind of high level strategy is, Alex, as far as, you guys are you in just the majors? Have you spread out across the industry? Are you in the physical funds? Maybe just talk briefly about that.
Okay, yes. So we're in a bit of everything. So we typically hold anywhere between 10, maybe up to 15, 16 different exposures at any time. And the way we look at the fund is we really look at two majors, Kazatomprom and Cameco, and we really kind of analyze those against each other, if you like. Then we have obviously the physical exposure, being Yellowcake PLC and UPC, and then we have the developers and the junior exposure. So what we do is we try to we move our allocations between these three groups based on a number of things. If we feel a little bit bearish to the dynamic of either uranium equities or the underlying uranium price, we will try to allocate more during that period to the majors and to the physical funds. When we start to feel like we should be a bit more bullish, we move allocation into the junior end of the sector, where we believe the sort of the equity performance will be greater. So we move up and down this risk chain within the industry, because, as I said, we can only invest in uranium or cash, and our investors own the fund because they want uranium exposure. So we don't tend to carry a very high cash balance, but we can't decide, oh, uranium's so good right now, let's buy some gold. So we have to manage this within the uranium industry, and so we spent a lot of time analyzing the Cameco versus Kazatomprom relationship. Specifically, we spend a lot of time looking at the sort of the actions of the physical funds and whether or not they're trading at a discount to their NAV. And then, of course, with our portfolio structure, you'll always end up with sort of a minimum of 6 or 7, maybe up to 10 different pre-development or companies with their assets on care and maintenance in the portfolio. So it requires quite a bit of active attention.
What about so let's use 2020 as an example, Alex. Maybe you guys can, or maybe you can share a little bit here. We had the March COVID lows, all uranium stocks sold off at that time. Did you guys actively purchase more at that point? How did you manage the March and I guess into April sell-off? And then from there, when we saw uranium, the underlying price of uranium go up to, I don't know what it was, 34 a pound, did you guys change focus a little bit and move more into Kazatomprom and the physical funds at that time eliminating exposure from the more volatile part of the sector. And of course, now we're back at $30 or whatever it is today. Talk about a little bit of that trading component that you mentioned and how you guys handled 2020 as an example.
Yeah, so I think we handled 2020 pretty well actually. As I said, we're we're up. We must be up around, as at today, it must be about 12% or something for the year. Maybe it's a little bit more, which for a large diversified fund with uranium exposure is doing very well, I think. So, and as I said, it's doing better than the peers that publish their performance. So coming into the year, we picked up quite a bit of performance as uranium really started the year as a bit of a theme, and we were relatively long juniors. We got hit around a bit in that COVID trade, but as you said, but uranium sort of bounced back relatively well in the aftermath, and our names did quite well. What happened as we came into towards the end of spring, we started to become very nervous because we could see that the market was not functioning properly. This is when I think when we saw Cameco's results for Q1, and we saw that Cameco was roughly, might have been around 40% of all spot market purchases, and we started to see things that I've never seen happen in uranium before. I've been working in uranium for specifically in uranium for around 11 years, and in my job at Paladin, I obviously managed a business that was selling physical uranium globally and delivering into contracts, and I understand very well the dynamics of the different converters. And we saw this very unusual thing happen where let's say two key things showed me that there was something ill happening in the market. Number one was the spread between converters. For uranium spot delivery at Cameco ended up having a $4 premium to non-Cameco converters. And by the way, historically, Cameco always had a 25-50 cent discount, and that's because there's a little bit of there's taxes you pay and you eventually get them back. Most of the traders prefer not to deliver into Cameco's converter. So that was very unusual to me. And then the second thing is the uranium forward curve went into backwardation, and uranium forward curve is a little bit like gold. It's almost always permanently in contango. And that really told me that the only thing moving spot up or keeping it up at the time was Cameco's buying, and specifically Cameco's front month buying. So when we saw that happen, we moved into the bigger names, and we moved more into Kazatomprom and the physical uranium funds, because we knew that the real price of uranium wasn't 34, that it was about 30. That was really what we felt the excluding Cameco transactional value of uranium was about 30. We're trying to have a look at, we're looking at transactions that were happening further down the forward curve and things like that. And so we kind of felt like, well, our concern is that the price might go below 30. The real price might go below 30. So we sort of, we de-risked the portfolio quite significantly. But as the summer progressed, and we were at, a couple of months ago, was quite clear that Cameco's buying was coming off and the market was normalizing. And I feel really good about the market right now because the market is now in a position where it looks like it's functioning and operating correctly. but the spot price has not dropped substantially below $30 a pound, which, when you consider everything else going on and coronavirus impacting utility buy or whatnot, I think that's a pretty robust place to be. And so in September, we've allocated more aggressively in the portfolio. Yeah, so we're a bit more in the juniors now than we were, and I think that move has helped our portfolio performance a little bit. The uranium equities didn't come off as much as I thought when the uranium price came off and started to normalise, but they definitely came off a bit. So we sort of picked up a little bit of performance there, I think.
Going forward here, we've got U.S. elections coming up, which can bring some volatility. Maybe not specifically to uranium, but certainly if there's anything like a volatility type action like we saw in March, we could see uranium equities get sold along with everything else. What's your thoughts coming out of the election here in the U.S.? And then what do you see as some forward future catalysts on the uranium side of things, Alex? What's your feeling on next year if utilities are going to start looking to make some purchases? Do you think it's all still kind of up in the air with COVID, the elections? When do you see things starting to take that next leg? What's your thoughts going into 2021?
So I think the US elections are win-win for uranium, which is not always the case, but both, but Biden's platform incorporates nuclear as as part of his carbon-free power generation, and Biden's gonna sign the COP21 Paris Agreement and sign the US up to carbon reductions target, which is very positive for nuclear. But Trump, without having as clear a holistic energy or environment policy, has been a relative supporter of nuclear power as well. And there's been a number of initiatives, as you know, that have been very, very focused on trying to get more of the nuclear supply chain trying to reignite the activity in that domestically in the US. So I think both presidential candidates are very positive. So that, I think, we've got an election coming up which is pro nuclear, so that's a good thing. I think in terms of utilities definitely, I think they've been less present in the market this year than they would have otherwise been with respect because of COVID. I really felt like 2020, late 2020 or second half of 2020 would be a big time. Now, I got to tell you that in my time in the uranium business, the conferences are actually very important. There's three major conferences a year. One that happens in April and May. Then you have the World Nuclear Symposium that happens in September, and there's another sort of supplier utility conference that happens in late October or early November, depending on the year. And these are important because sometimes utilities will do bilateral deals, sometimes they'll tender materials, sometimes they'll determine to buy in spot, and how they enact their purchasing decision is influenced by the intelligence that they gather. And their main forums for meeting with suppliers are these three conferences, which have all been cancelled this year. And I think that has had an impact on purchasing decisions. I think there has been a sort of a lower requirement for nuclear power this year because power in general generation is down globally. But albeit for nuclear, nuclear is done better than almost any other source of generation. It's probably only going to be off about 1.5-2% by the end of the year. But I think some of these factors have pushed utilities into next year, and I just think we probably got. I kind of felt like 2020 was going to be a taste of things to come, the first step in the direction of 2021, which was going to be a big year, and so it feels like coronavirus might have delayed that by 6 months or more. But definitely the utilities are in a precarious position. In the short term, the utilities need to contract to do a combination of buying contract plus spot, getting up towards about 180 million pounds a year. So over the course of the next decade. Now, once they start enacting that activity, then the deficit in uranium supply is really going to show itself in uranium price. So I can see 2021 is going to be a very interesting year, because whether or not COVID is still with us in 2021, we're getting very, very close to precipitous falls in contracting books for US and European utilities.
Alex, what's your thoughts on some of these other, I guess, side factors? Give me your thoughts. First of all, so you got Cameco coming back in with Cigar Lake. I think you and I both agree that that's a financial decision, and it's about their finances at this point.
Yep. Yep.
And also certainly agreed on the 180 million pounds a year. That comes really close to what I expect as well when this starts kicking off. But I also think that, looking at the US and European utility inventories, while they are historically low, they could stretch it. And I think COVID will stretch that certainly into next year, possibly into the following year. People often talk about Kazatomprom, still not being very disciplined, or they want to get US dollars because of their, the national currency, the 10G. I don't know that the currency portion of that makes as much sense as it used to. But let's say they seek US dollars and they want to continue to sell uranium. Give me your thoughts on those factors, and then I want to talk about M&A.
Okay, so Cameco first. Cameco, I think, as you say, I agree with you. Cameco was burning cash. They got by in the first quarter of this year, by releasing inventory, and it sort of that, and there was a few other bits and pieces like a contract settlement that made the cash balance stay where it was. But in the second quarter, it was pretty obvious to everybody what's going on. That as the uranium price is increasing, they're buying more and more, and they're delivering into a mix of spotted contracts so they're effectively selling. They're effectively selling for less than they're buying, and it's a short-term game. So this is really why they're supposed to start Cigar Lake. Now, a few things on Cigar Lake. You're talking to someone that has built mines before, has commissioned them, has actively managed mines before, and it never ceases to amaze me how the investment community or analysts sort of underplay the risks to restarting a mining operation and the costs. So, when you look at the way, Cameco has previously said, Cigar Lake's going to restart. We think it's happening in September. And when you look at analyst numbers for Cameco, I look at those numbers and I say, well, firstly, where's the working capital for the restart? I can't see it in your numbers, right? A mine like Cigar Lake could potentially eat, 150 million Canadian dollars in working capital as it builds a stockpile of ore, of uranium in solution in the plant, of drummed uranium, and that's something I think that people analysing Cameco are not very focused on. I think the second thing is Scar Lake is a very, very complex operation, and one of the more complex mining operations globally, and the potential for this to have delays, to have ramp up issues, is is quite substantial. So when you when you switch on a mine, it's not like switching on a Coca-Cola bottling factory. All the bottles are lined up and they just start. You start drawing electricity and the syrup goes into the bottles. It's a it's a very, very different thing. And Cameco will have lost experienced workers. They'll be having to retrain staff. Safety issues, if you like, as they come up, can slow or suspend various parts of the operation. They have Indigenous employees who've been recognised in Canada as a group that is susceptible to coronavirus and needs to be protected. And so firstly, I think the potential for Cameco to disappoint, and not only do analysts incorporate that's a Cameco localized disappointment in terms of having those issues show up in Cameco's operating and financial numbers, but it's also a disappointment for uranium supply globally because people already put Cigar Lake back into the model and pretty much assume it's going to be running at full tilt in 6 months from when it gets switched on, which in my view, I'm not saying that's not going to happen because let me tell you, Cameco's management are first class in this regard. They're technically extremely capable, but this is the mining business, and things go wrong. I'm concerned that this is going to be there's going to be there is a probability of a disappointment of a Cigar Lake restart that is not being talked about, or it's not being factored into people's considerations for the short term uranium market.
Yeah, with their move coming back, they got to experience what it's like to buy a bigger volume in the spot market and how that impacts their financials. Do you think the move with taking Cigar back has to do with a little bit of their uncertainty, Alex, about how long it's going to take for this market to get to incentive price to where they can sign new contracts to recoup that effort? Do you really see Cigar as really bringing that back as a safety policy and adding a little bit of runway to their finances if they had to continue to stretch this out, say the next 3 years?
I do. I think that Cameco were probably disappointed in the market impact of their on market buying. So I think they probably felt like uranium prices would go even higher. And where, in sort of the $30 to $40 a pound price point, they're in a very difficult position because frankly, if uranium spot price was back at $18 a pound or $20 a pound, the decision to buy on market is okay for Cameco because they've got legacy contracts in there that they can buy at 18 or 20 and make a profit. At $50 a pound uranium, if they get the price there by buying on market, then no problem because they can start to the long-term contract price will move up and they can start to contract at higher prices, and the transition from spot buying to restarting the mining business is a whole lot more certain. This $30 to $40 is very, very uncomfortable because it's a loss-making zone for them in the on-market buying, yet it's not a high enough price to very clearly justify a strong return on capital for restarting the mine. I think Cameco I think they had a swing at getting uranium to 50 by themselves, but they just weren't enough. And I think then they had to sort of bite the bitter pill and restart the mining business because they have debt coming due. If they can make a positive margin in the mining business, no matter how small it is, they have an asset that is is easier to put a refinancing story around than a business that has no operating mines and simply buys uranium at a higher price than they sell it for. So I think, Cameco decided, let's not get the cash balance close to zero here. Let's admit that our on market strategy didn't get us as far as we wanted. And there might be things like coronavirus impact on utility buying and things like that impeded that strategy. But the simple fact is that that was never going to be a long-term strategy if it didn't get uranium price high enough, because next thing you know, you're repaying some of this debt that's coming due. You have no ability to refinance that with additional debt because you've got a negative margin trading business, and that's it type thing. So I think, and I know from someone who's run a uranium producing business, if you can make money out of the production, even if it's a very slim margin, that's a better proposition for financiers than a business that has all assets effectively on care and maintenance and is cash flow negative.
Yeah, good points. And, certainly the bit about some of the restarts, there's no doubt that any notable restarts will be 12 to 18 months out. So that adds another
Yeah.
dynamic to just the runway that utilities have with their current inventories and the time it takes to get those restart decisions made, which won't be made until the incentive price is in place on new projects, or I guess brownfield and greenfield development projects. I'm looking at the list here. It doesn't look good for any notable projects to be built. We're at 2021 here shortly. I don't see any notable project being built until 2024. Yeah, there's some small ISRs and some other things that can come online before that, but I don't see anything notable until 2024. So it really puts an interesting, dynamic on the between a rock and a hard place, if you will. Talk about for Kazatomprom, talk about their desire for dollars and talk about their current situation. What's your thoughts on Kazatomprom here?
Well, I love Kazatomprom, and a lot of people are very negative on Kazatomprom. And there's other investors in the uranium industry or funds that have in the past, really taken me to task on my my support for Kazatomprom. But by the way, Kazatomprom's been a great investment. I mean, it listed around. I think it was $11 was the IPO price a couple of years ago, and probably around 2 years ago. That's right, around $11. It's paid $1.80 or it's probably paid $1.60 in dividends, and it's a $14 stock. It's had the best performance in the uranium industry in that period. Now, if you want to buy electric car company, most people are going to buy Tesla, right? Kazatomprom, yeah, sure, it might be from Kazakhstan, but it is the number one benchmark company in the uranium industry. Cameco is not. Cameco just happens to be sort of quite well known in some circles because it's listed in the US and Canada, and it's been around for a lot longer. But, Kazatomprom is the class act in the industry, and they make cash at current uranium prices, and they make that cash selling at predominantly at spot. So, Kazatomprom, if you want to buy it at $14 today, they're going to pay you around a 5% dividend yield based on the cash they're making. And if uranium price doubles, the stock will probably double. So I quite like that structure. Now, in terms of the currency, I think where that's important, I mean, Kazakhstan has a much bigger source of US dollars than their uranium industry. Now, Now, Kazakhstan is the world's #1 producer of uranium, but uranium is not the biggest industry in Kazakhstan. Their oil and gas industry puts uranium, it pales it into insignificance in the scale. So, and their oil and gas industry is also heavily state invested as well. So, if the government of Kazatomprom needs money, it gets it predominantly from the oil and gas industry. Now, having said that, the currency is extremely important when we analyze Kazatomprom because Kazatomprom's cost structure became a lot more competitive in 2015. And the reason for that was the Kazakh tenge was sort of a managed currency, and it was at the time it was trading below 200 to the US dollar. In that like 180 or something like that, and it was basically pegged. The government set the exchange rate, and eventually, the economy moved against them, and the government ran out of US dollars, and basically one day in 2015 said, "Well, forget it. We're gonna float the currency," and the tenge went to like 360 or something like that in the space of a few months. It the value of the currency versus the US dollar halved. And that in 2015 created a huge one-off reduction in the cash cost of production for Kazatomprom, and it kept them able and willing to expand their production in 2015 and 2016 and 17. And in my view, this lack of discipline by Kazatomprom in those years was one of the reasons why the uranium market has taken a lot longer than other commodity markets typically take to correct. Now, the tenge is still weak. It's still it's more than 400 to the US dollar today. So although that one-off benefit is a few years behind us now, inflation's very high in Kazakhstan, and Kazatomprom's costs are rising. So I think that, but we watch the tenge because as it weakens, we know that in domestic currency terms, they're still making a good margin. As it strengthens, if it goes through a significant strengthening, I think we'll start to see Kazatomprom becoming even more disciplined. Now, they have been relatively disciplined in the last couple of years. I think sometimes also people misunderstand some of the things that they say, like during coronavirus, when they talked about managing their wellfield development. They didn't say they'd stop it. They just said that they would curtail it somewhat. I think in the last couple of years in particular, Kazatomprom has generally done what they've said. Now, and what they are saying is they 100% believe in a disciplined market strategy. They have a value over volume strategy. And they're one of the reasons why uranium in the year of coronavirus is still at around $30 a pound spot price. I think it'd be if Kazatomprom was genuinely indisciplined and was chasing the very last dollar, I think uranium prices would probably be in the mid-20s. Now, we got to keep an eye on Kazatomprom, not only obviously because it's an investment that people should consider, but it's also something we need to, as I said, it's like watching what Saudi Arabia or OPEC does to see what might happen to future oil prices. Kazatomprom definitely has that position in the industry, but I love it. A lot of people don't like it. It's not in everyone's uranium portfolio, and I do not know why, because you would have had $3 of performance and $1.60 of dividends by owning it in the last 2 years, and name me a major stock in the uranium industry that's done better.
Yeah, no, absolutely. Great points, and a lot of stuff we can continue to discuss on them. They have, of course, a number of challenges like the industry does ahead of them, but certainly they're in a good position. Let's move on here just for the sake of time, Alex, although I'd like to keep chatting. What's your thoughts on, there's been some minor sector M&A, kind of on the lower end, the junior space. There's been a little bit of that, and there's been some chatter about, there's some new companies that have popped up, and people have increased their chatter about mergers and acquisitions and consolidation. What's your thoughts on that? What do you think is likely on that front? And then also, while we're on the topic of the junior space, maybe you can share some comments or maybe some companies that you like for the audience that you might have your own money into.
All right, so M&A. The first thing I'd say about M&A and uranium is what another thing that's quite unique about uranium is we have so many uranium deposits, and the world is a very long resources compared to current production. And this is because uranium was, it still is to an extent, a strategic commodity. So, when nuclear weapons were discovered, or that use for uranium, governments globally searched for uranium everywhere. So the governments globally invested a lot of money in uranium exploration. Then, of course, we had the uranium power boom, and which led to a second massive uranium exploration boom. So what I have to say in uranium is whereas for some commodities, like copper, for example, exploration is absolutely key to copper because there's just not enough copper resource globally. The world's resource divided by production number for copper is declining, and the grade is declining, and it's becoming a great concern for the copper industry. We need people to invest and find more copper. In the uranium industry, we don't, right? There's uranium. There's more uranium than we can poke a stick at. And so, as sentiment picks up, there's a lot of assets that will appear in junior companies that are irrelevant, or they're in countries that are hopeless, or they have management teams with no experience, or they have no prospect. So we'll see these assets emerge, if you like. I do think exploration can be interesting in uranium in certain areas, but it's not a big value driver for the industry. So I don't think we focus as much on junior explorers. M&A, I think, will be quite important, and the M&A focus, I think, should be in North America, and the US is crying out for someone to take leadership of the American uranium space. The policies in the US are becoming more supportive for domestic uranium production, but that as yet nobody has stepped up to create a vehicle that is, has the capital base and the sort of appeal to capital markets to be the granddaddy of them all. You can see that, Energy Fuels has its nose in front, but then they also have a focus on rare earths as well. There have been some people acquiring sort of conventional assets in the US, and whereas I think the game would probably be a bit more focused on ISR in the US. So, I'm looking for some of these companies to consolidate here. I'm talking about companies like UEC, UR Energy, Azaga Uranium, Encore, which is Bill Sheriff's company, which has come up and obviously been acquiring some some assets, and Bill has a history as well. So frankly, 3 of those 4 companies should be one company. In a way, the market's crying out for this. Another logical form of M&A is probably going to happen in Canada. Cameco is actually, this whole sort of lost decade since Fukushima, Cameco has been burning through its resources, and it's starting to look like it's got a bit of a short mine life. Then you've got Fission and NextGen with deposits that look like they show great economics, and Denison as well, with good assets, looking like they have some prospectivity. I think 1 or 2 of these should potentially merge as well. The issue you have a little bit is relative valuation. A lot of people tell me that they own NextGen because Cameco is going to buy NextGen, and I look at these two and I say, well, Cameco's not going to spend 50% of its, or 40% of its market value once you think about paying a premium for NextGen for earnings sort of 7 or 8 years down the track, right? It's just not going to do that. NextGen's too expensive for Cameco to buy them. And so you got this, in that Canadian space, industrial logic tells you that, Cameco's management should be the logical people to develop NextGen's assets, or Fission's for that matter. But there's some other things going on in a valuation sense. But this is a long-term game. But definitely there's some logic to some pairing up there. So I think we need a US champion, and we need some of these undeveloped deposits in Canada would logically fit. If Cameco wants to continue to be a major player in the industry, then I suspect they need to fit in. Now, consolidation elsewhere, it's really not necessary or interesting. Are some people going to get together in Niger? I don't know, but in a way, who really cares about Niger? I mean, it's a difficult place to go to. Malawi, these kind of places. I don't know. I think the M&A, the M&A scene is going to be a US story, and I'm really hopeful that in the next cycle there's a US major that emerges off the back of some domestic production leverage, but has the potential to become an international company as well, an international player.
Alex, and how do you see it coming together as far as timing? Do you see some of this happening early on? Look, you and I both know that companies that are more responsible and that have the capability from a cash perspective to make these acquisitions early in a bear market, or, in an early stage bull market like we've seen in the gold sector and also the copper sector, where assets have been acquired very cheaply during bad times, obviously makes more sense from a value standpoint than trying to do acquisitions mid-late cycle. But talk about, just for a moment, when do you see them happening? And then also, obviously, in the meantime, we know some of these more bigger popular companies will continue to burn through capital. In Canada, Fission and NextGen will continue to burn through capital substantially as things progress here, because they probably won't do anything. And if they do anything, it's going to take them, like you said, 7-8 years, and that's probably being a little bit optimistic, unless, of course, the market takes off and uranium price is so high that everybody's on board with fast development. But talk about the Namibia aspect. You mentioned Niger, but talk about Namibia and maybe how companies that are looking at Australia and Africa, or companies that are looking at Namibia and Australia, how that might also play a role in potential M&A.
Yeah, in Namibia, you've got Paladin, Deep Yellow, Bannerman, really those 3, and then you've got the Chinese-owned mines, Husab and the former Rio Tinto mine, Rossing. I think that the Chinese are generally in a pretty reasonable resource position there, and they're also the assets that they own in Namibia are difficult assets, so they're busy scratching their head with those 2 assets. I think you know, at some point I can see Paladin probably, wanting to acquire more resources in Namibia, but that has to be quite some time off. It has to be in a time where, it's achieved its advancement in terms of restarting Langer Heinrich and optimizing Langer Heinrich first. I think there's some great initiatives that could be introduced there that can optimize in a processing sense Langer Heinrich, and once you do that, you open the door to be able to transport ores from deposits nearby and or process some lower grade ores. But I think that kind of consolidation is years away. Yeah, I don't see, and two big issues with near term consolidation. Number one is when you're an executive of these companies and everybody's worried about the fact that your commodity price is still low, your investors are telling you not to do anything. They're telling you, oh, don't spend money. Please don't do anything that that you know that might cost money or look interesting. And so now uranium prices obviously come up off its lows, but I don't believe that the sector in general is yet past the survival mode mentality, right? Can Mark Chalmers go out and buy two or three of these, junior uranium companies in the US? I don't think so. Not right now. I think his shareholders are still telling him, listen, we're very worried about what happens if uranium price goes back to the early 20s and blah blah blah, and whether or not these companies need capital or whatnot. So I don't like the first stage of an emerging bull market usually comes with new juniors emerging in that commodity. We're starting to see that now with with Encore, for example, as a new company, or on the ASX with something like Lotus, or Superior Lake becoming a uranium company. The stage at which we start to see the M&A action take place will be when management teams have more confidence. So the first thing is this issue of confidence in the management team. The second thing is the personality thing. I could tell you, like, the uranium industry is smaller than other mineral, commodity subsegments, and it's more, people know each other better, which can be a good thing sometimes, but it can also be a worse thing. And because uranium has had many years in the last few decades of doldrums, it hasn't brought in a lot of new blood into the industry. And so you got a lot of people that know each other very well, and for one reason or another, that probably precludes M&A in some senses. So some of these people, firstly, they need more confidence, and secondly, that they all need to sort of put their grievances aside and get together. But the next stage of a bull market will answer those questions, because some of these deals will become more compelling. They're not as compelling right now, because they're only compelling when you can act on the acquisitions. It doesn't matter how cheap something gets. If you're warehousing that acquisition and you have no idea when you're going to develop that property or when the synergy is going to be achieved, it's not an interesting thing to do. If you start to look at acquisitions, you say, well, I can have that cooking in 4 or 5 years' time as another source of production, or 3 years' time, or whatnot. That becomes a lot more compelling, and we need the next stage of uranium price increase to get there.
Yeah, I agree. I think that there is some friction there with some of the existing management teams and the unwillingness to work together and to come together and get into the same bed. And then I think you're also right on that front. I think there's a bit of a capital problem and also a bit of a confidence problem. So I think it is very walking thin ice, I suppose. What about, just briefly, any companies that you'd like to share that you like or that you personally own?
Okay, so PA, outside of the fund, I own, I've got some shares in Kazatomprom, I should say, for the reasons that I set out previously. I like Paladin as a very leveraged play to uranium upside. Now, Paladin, though, is a little bit more of a timely bet, right? Because Paladin has its debt is due in March of 2023, and unless uranium prices really moved on, that is going to become a risk for Paladin. So if you think uranium price is going to go to you're going to really start moving here in 2021, then there's very few companies are going to offer you the same kind of upside in terms of share price performance, but also liquidity to be able to trade in and trade out as Paladin. But if it doesn't happen in 2021, in 2022, people are going to suddenly start to be looking at saying, listen, there's a bond due in March 2023 and this is a problem. Okay, so Paladin is a great investment if you can really put your finger on when you think and be confident about timing. As many people know, I'm a shareholder of Asahi Uranium, probably one of the biggest, if not still the biggest shareholder of that company. I was a co-founder of that company. That's one of the companies that might participate in US consolidation, or it's got a great project. It's a smaller size company in terms of resources, but it's the economics of its flagship Dewey Burdock project are exceptionally good. It can get developed at relatively low uranium prices, albeit it's been going through the permitting process for quite some time. But it feels like this is coming to a close here. And by the way, Blake, the guy running it, Blake Steele, is a relatively young guy. He's got no skeletons in the uranium closet, if you like, with all these other personalities. So I think in terms of somebody who's really open to being involved in consolidation, I think Blake is a guy that recognizes value and will participate in that. So they're sort of the three. I quite like Energy Fuels because it's relatively liquid and it's well funded. I think that I think in a way they've done the right thing by expanding a bit their focus into rare earths, which is bringing capital in and opportunities to make money for them. But once uranium really moves, the uranium business will still dwarf anything they're doing at the moment in rare earths. So it's still a uranium exposure when things really get moving. In the last uranium boom, Energy Fuels was one of the most liquid companies, and being listed in the US really helps in that regard as well. So and Energy Fuels, it's probably in the right position to be the one that drives the consolidation in the US over time. So those are names I like. But I mean, you can ask me about just about any uranium company out there. I mean, we've looked at them all. So
Well, Alex, what would you say just to folks that are considering the uranium fund at Eightstone Oclaner? What would you say to them about consideration of that fund, and who should they reach out to as far as if they're interested?
Well, I think at the start of the call you mentioned the website, and the chief investment officer is a gentleman by the name of Sylvain Baud. He's based in Singapore, and they can on the website you can go onto the website and email Eightstone Oclaner, and that email will find its way to Sylvain, and we can engage with interested parties. The fund, you have to be a sort of a qualified buyer, if you like. So it's not a fund that's completely open to retail, but I think I don't think it's super hard to qualify either. But Eightstone Oclaner would have to go through that process and have a discussion with someone interested to invest, and in that process you can find out more about the fund, what we do. It's structured in a way that our fees are also very low. By the way, we structure it as what's called an actively managed certificate, which is a relatively low fee structure. It's not like a hedge fund style fee structure. So I think it's an interesting way to get some portfolio uranium exposure that is managed by an experienced investment management company with all the proper risk management techniques, and then they take advice from me on portfolio construction and industry issues.
And for anyone who wants to reach out to you, Alex, any contact information for them?
Yeah, you can email me on alex@azargaresources.com, and that's AZARGA resources.com.
Well, that sounds good, Alex. Well, I really appreciate it. We covered a lot of ground here. Appreciate the discussion on the uranium front and everything else. Really appreciate you coming back and taking the time, and hope you're staying well out there, and hopefully one of these days you can get back to Australia.
Yeah, I appreciate you having me on, Andrew. You're doing great work to help people understand a lot more about these industries and investment opportunities. So, anytime I enjoy coming on. Thanks.